decades, the global economy was largely shaped by the influence of the United States. During the 1990s and early 2000s, a period marked by rapid globalization, America's economic power seemed unshakable. Stock markets worldwide mirrored Wall Street's movements. Central banks around the globe followed the Federal Reserve's lead, and countries aligned with US interests enjoyed access to markets, investment, and cutting-edge technology. In contrast, adversaries like the Soviet Union faced economic isolation and collapse, while China thrived as a cooperative partner. However, the economic landscape has transformed dramatically. Today, we see a world where the US is no longer the unchallenged economic leader, and national economies are taking divergent paths. This shift is starkly evident in central bank policies as they react to inflationary pressures, geopolitical challenges, and local economic conditions in vastly different ways. Interest rates, once synchronized with the Federal Reserve's actions, are now moving in conflicting directions, reflecting a fragmented global economy that's becoming increasingly difficult to navigate. The US's hold over the global economy has weakened significantly. In 1990, the US accounted for 21% of global GDP, and the Group of Seven, G7 nations, comprised 50%. Fast forward to 2024, those numbers have dropped to 15% and 30%, respectively. Much of this shift is attributable to the rise of China and other emerging markets, which have not only increased their economic output, but also exerted greater influence on global trade and financial flows. The International Monetary Fund, IMF data, underscores this reality. The dollar's share of global reserves has fallen from 72% in 2000 to just 58% in 2023. Meanwhile, China now settles nearly 25% of its trade in yuan, a sharp rise from a negligible share only a decade ago. At the core of this changing economic order is the increasing divergence in central bank policies, particularly around interest rates. In the past, when the US Federal Reserve raised or lowered rates, other central banks typically followed suit, fearing the repercussions of straying too far from the global leader. However, today's economic conditions vary so drastically between major economies that central banks are no longer marching in unison. In the US, inflation spiked in the wake of the COVID-19 pandemic, forcing the Federal Reserve to hike interest rates aggressively from near zero in early 2022 to over 5.25% by mid-2024. While the Fed was late to act initially, its hawkish stance has persisted even as inflation has started to moderate, creating a prolonged period of higher borrowing costs that continues to reverberate through the global economy. This prolonged rate hike cycle is already contributing to a tightening of credit conditions and slowing economic growth. In contrast, Europe has faced a more complex inflationary challenge, exacerbated by the war in Ukraine and the resulting energy crisis. The European Central Bank, ECB, and Bank of England responded by tightening monetary policy earlier than the Fed. By mid-2023, the ECB had raised its key interest rate to 4.25%, while the Bank of England moved even more aggressively, bringing rates to 5.5%. Both central banks have since adopted a cautious stance as inflation remains persistent, yet the possibility of recession looms large over their economies. Japan, on the other hand, presents a vastly different scenario. After decades of stagnant growth and deflation, inflation has finally taken hold, albeit at moderate levels. For the Bank of Japan, BOJ, this shift represents an opportunity to slowly normalize monetary policy. However, the BOJ has taken a cautious approach, raising rates incrementally from their historically low levels, but remaining far from the aggressive tightening seen in the West. As a result, the yen has experienced wild fluctuations, driven largely by the widening interest rate differential with the US-China's central bank, meanwhile, is dealing with the opposite problem: deflation and a cooling economy. While inflation has surged in the US and Europe, China has seen its growth sputter, with consumer prices declining in some sectors and economic activity slowing significantly. In response, the People's Bank of China, PBOC, has been cutting interest rates and implementing stimulus measures aimed at propping up its beleaguered property market and boosting consumption. However, China's debt-laden economy leaves policymakers with limited room to maneuver. This divergence in interest rate policies has led to significant volatility in global financial markets. Japan's experience with the yen illustrates the ripple effects of asynchronous central bank moves. Early in 2024, the yen depreciated sharply against the dollar as the Fed hiked rates while the BOJ remained dovish. By midsummer, the yen had regained strength as investors anticipated a more hawkish stance from Tokyo, only to fall again as the BOJ maintained its cautious approach. The currency's fluctuations have profound implications for the global economy, given Japan's role in the 4 trillion yen carry trade, where investors borrow cheap in Japan and invest in higher-yielding assets elsewhere. When the yen appreciates, these trades unwind, causing ripple effects across global markets, from US equities to emerging market currencies like the Mexican peso. In Europe, the rise in interest rates has fueled a stronger euro and British pound, but at the cost of economic growth. Higher rates have dampened demand, particularly in industries sensitive to borrowing costs, such as real estate and manufacturing. At the same time, Europe faces an ongoing energy crisis, with the war in Ukraine cutting off supplies of cheap Russian gas. This combination of factors has heightened the risk of recession in the Eurozone, even as inflation remains above target. In China, the PBOC's efforts to stimulate the economy through rate cuts and fiscal measures are expected to have significant global repercussions. A Bloomberg economics model suggests that China's stimulus package announced in September 2024 could inject as much as $300 billion into the global economy over the next year. This influx of liquidity could provide a much-needed boost to global growth, particularly in emerging markets that depend on Chinese demand for commodities and goods. However, the long-term sustainability of China's economic recovery remains uncertain, as structural issues such as high debt levels and an aging population weigh on its future prospects. The growing divergence in central bank policies underscores a larger trend: the diminishing ability of the US to shape global economic outcomes. For decades, the US dollar's dominance and the Federal Reserve's central role in setting global monetary policy allowed Washington to exert outsized influence over the global economy. But as other nations grow more economically independent, this influence is waning. In 2024, the US faces the challenge of navigating an increasingly multipolar world. The rise of China, the resurgence of Russia despite sanctions, and the growing economic autonomy of emerging markets like India and Brazil are all chipping away at the unipolar moment the US once enjoyed. As central banks around the world pursue divergent paths, the US must grapple with the reality that its policies no longer dictate global outcomes to the same degree they once did. In this fragmented global economy, understanding the nuances of local economic conditions, central bank decisions, and interest rate movements is more critical than ever. For businesses, investors, and governments alike, the stakes are higher and the margin for error is smaller. Economic dominance is no longer concentrated in one place. It is being redistributed across the globe.